Feels exactly like 1999. I don't know whether we'll actually replay it exactly, but I think all the ingredients are in place. And certainly from a trading standpoint, you have to position yourself like it's October 99. I don't see why you would do anything but that. And remember, the Nasdaq doubled between the first week of October 99 and March of 2000. So if it looks like a duck and quacks like a duck, it's probably not a chicken, right?
I've heard him and his team use that saying before in the Trader documentary about the 1987 stock market crash.
It's really pretty scary. You know, if it looks like a duck and it acts like a duck and it sounds like a duck, it's probably not a chicken. And that's what's scaring me about the activity in the stock market right now.
Some analysts disagree, but Paul Jones and Peter Burish are among those who think there's a crash coming, and a big one.
A lot of the headlines in the news were rather bearish. However, if you did listen to the interview, he was talking about the potential for a blow-off move in various assets, and they could go significantly higher. Here's another piece of that interview.
You just think about bull markets, right? The greatest price appreciation is always the 12 months preceding the top. I'm not suggesting the train's going to crash. I'm suggesting that we're in a period that's conducive for massive price appreciation in a variety of assets.
Well, there you have it from the legend himself. It gives us an insight into what he sees taking place in these markets. It feels like 1999, although he does see the potential for a stronger move in the markets. So that's what we're going to talk about in today's Stock Market Brief Show. Let's get into it. Welcome back to the show, everybody. We're looking at the chart of the Nasdaq 100, and this is the 2000 top over here before the busting of the dot-com bubble. And as Paul Tudor Jones was saying, you know, similar to potentially August, and he's looking for a potential strong rally before this bubble ultimately bursts. And I did find it interesting because, you know, we have Trump back in office. And if you go back to his first term, we've been making the very closely correlated analogs of what the dollar and the market's been looking like. And if I go to October of 2017, his first term, you can see the market went a little bit higher, pulled back in, and even into 2018, we saw actually a pretty large squeeze in the markets before running into some rather large volatility and then heading higher before, once again, the market seeing significant more volatility, even coming back to and around that October level that we just pointed out. So I'm looking at this and I'm hearing, you know, what Paul Tudor Jones is saying, and there are a lot of strong stocks in the market, a lot of strong various assets in the market, and a lot of strong stocks that have just been consolidating and going quiet. And as the market kind of continues to press on, which will bring up that chart, we haven't really seen a significant down day in the market yet. And I think that maybe something that could be just right around the corner, but that doesn't necessarily mean that it's over and done with. I think that that's going to be a shakeout phase in the market, very similar to kind of what we saw over here, where the market continued to kind of squeeze higher, and then we see this, you know, massive move in the Nasdaq, you know, down 700 points, right? It was only 7,000 at the time, and it moved 700 points, so obviously the Nasdaq's a lot higher now, but that's a pretty large drop-off, large rip back, large move back, and so forth. And I think what can really cause this is what we've been saying, right? That the market's been moving higher with flows. And if you look at things like CTA positioning, right? We were at the lows over here. That we started saying CTAs can become buyers and they can really help elevate this market. The market completely went above and beyond, right? To new all-time highs, which feels like daily. But if you look at where CTAs are now, yes, they can go higher. But if you look back to the left, we haven't been this high since 2020. Leading into really the pandemic. And that was kind of there was a very strong move going into all of that volatility there in the pandemic. You can look at vol control funds as well. This is the highest we've seen them since, well, this chart goes back to 2021. It's the highest level since then. The same thing goes here, right? When they were, the blue line is the vol control funds. When we were at these, you know, rather depressed levels over here, I guess I could say, the market was also on the downside. And we said when these also become buyers of equities, right? When it starts suppressing volatility, the market can go higher with these flows as well. And well, now the same thing goes, but on the flip side, when we start to see maybe a 1% down day, 1.5% down day, that could quickly turn into something like multiple down days or 2% down day, something that we haven't seen for a while, because all of a sudden you have systematics begin selling as well. So it's going to feel a lot more aggressive during the day than what it actually really is. So it's going to be very important to map out very specific levels of risk in the market and track them closely so you don't miss out on more potential upside as the market's still progressing. And what I do is I like to look at gamma exposure levels, and you can see the call wall right now is at 6,800. That's where many traders are concentrated at. Price right now is below 6,800, but we are holding above 6,700, and there's really not much below that up until, about 50 points lower. So we got to really hold above that 7,000, maybe go and test in and around that 6,750, which we were basically at today before kind of backing off a little bit. And then it's just something to note that traders are still continuing to reach out further. That over there is that 7,000 strike, which is in and around the upper bounds of the JPM collar as well. Now, as far as the weekly expected move goes for the SPX, 6809 to the upside, which is basically right in around where that call wall is. So if the market wants to continue to press higher, being that this is the call wall and the upper weekly implied move, there's a high probability that you can get rejections in and around these levels, and or for price action to kind of just pin around and get stuck there. Okay, so if we get like a fast aggressive move by tomorrow, say it's Tuesday, say tomorrow, Tuesday, we get there, I wouldn't expect there to be much more upside in the week, given the context of where that remains. So we'd have to see what the data looks like if we were to get there and then go from there. Now, tomorrow's daily implied move brings us to 67.68 or 67.12. That's a very small implied move. And the reason why it's so small is because, well, right, volatility has been being suppressed as the market remains above the gamma flip line, which is roughly at about 66.40. So I think once we crack down wherever the gamma flip line is at the time that we crack down it, that's what can really, that's when you got to just be very, what's the word that I'm trying to look for? Diligent in your risk management, because things can change dramatically, and if you're not prepared for it, you can get out at the wrong time, you can try to buy at the wrong time, right? You might hold too long, or you might not get in when is appropriate. Okay, if we look at the direction of the 5-day moving average across the SPY, Qs, IWM, DIA, XBI, semiconductors, when we started turning red over here in yellow, one of the things that we called out was how semiconductors still remained above a rising 5-day moving average, and that was actually quite bullish. It would have been much more bearish if this would have crossed under. Now, semiconductors continues to kind of just lead the way as it presses higher and higher. Today, there was news about OpenAI with AMD. We saw just a massive explosion in market cap, and over 30% of the day, or when it started, over 30% move, finished at the lows of the day, but still 23% higher in a single trading session. He saw some very interesting move. This is why you got to be careful, right? This was down 18% within 5 minutes. This is AppLovin, because I think it was something to do with an investigation or something with the SEC. I don't have the news article in front of me, but yeah, we're talking 5 minutes. So just be careful with like some names, like they've been going crazy, right? You have quantum names showing massive strength, huge moves in Rigetti, which I traded intraday today, IonQ, QUBT, there's all kinds of those quantum names, and they've been seeing massive, massive moves. And just be careful, because there will be a day that if you're the late stage investor, you're going to have days and weeks where it's down 20%, like piece of cake, right? Those things move at a very, very high beta or a high volatility. In other news too, Verizon, the CEO stepped down, Hans, and we have a new CEO coming in, which, Verizon down 5% in a single trading session. That is a massive move in a single day for a stock like Verizon. But you also saw names like T-Mobile back off a bit, and also AT&T as well. On top of all of that, the government is still shut down. So we'll just continue to see how more news, what news comes in if we reach a deal and so forth. But right now, it's, I guess, the 6th day that the government's been shut down. The longer this, holds, the more things that can potentially go wrong in markets. We will continue to monitor that. As far as what's happening this week, we do have FOMC minutes on Wednesday. Fed Chair Powell is on Thursday. And then we have just a bunch of Fed speak, bunch of Fed speak, basically throughout the entire trading week to be aware of. Today's trading session did start higher. We came off a little bit. almost filled the gap or basically filled the gap, went a little bit higher. No daily implied move was tagged, but we're just kind of, floating in and around a consolidation of higher highs, right? Sorry, higher lows and matching highs over here. Now, I'm still keeping a very close eye on this VWAP. This VWAP is the start of October, happens to also be basically the lows of October, which, by the way, I bring this up because the last 3 months prior, every single month last quarter, the first day was the low of the entire trading month. So that'd be pretty wild to have 4 months in a row where, the first day of the month was the low. So we're not too far off the low by any means, right? We're talking 671 and the low over here was like 662. But this door will open up more if we start to get underneath the VWAP from this October. And you can see we had our first initial reaction, nice and big, tested it again, bounced up from these levels. So as you see, the more times that we test this, the more likely that it is to potentially break down, and that could cause some selling in the markets. But we haven't done that yet. It's not there. As far as the new daily implied move, we're looking at about 675, 677-ish range. These were manual calculations over here for the daily implied move, 668 to 666 down beneath us, which would be, not too far off the October VWAP and the inclining 5-day moving average. For the week, the weekly implied move is down here at 659 and then up here at 678 and some change there as well. So that's what the market said. Hey, we're pricing this in for the entire week. Just so you know, last quarter, some of the statistics around the weekly implied move for, there's 14 trading weeks in the quarter. 70% of those weeks were tagging the weekly implied move, 70% of them. So that's why I say it's so important. And of those 70, 5 of them actually exceeded the expected moves. However, 4 of those 5s only exceeded it by like a very, very small margin. Like it closed slightly outside of it. There was only 1 week that closed well outside of it. And then out of all of those weeks, we did not see any. We saw 0 2 standard deviation moves in last quarter. So it's important to know these levels of risk. Why? Because the market typically goes for them. And when we reach those levels, things tend to stall out a bit. Okay, that's why it's so important to know what the market is pricing in terms of risk. And if we continue on, we'll look at the 11 sectors that make up the S&P 500. We had tech lead the way today. No surprise there. We had semiconductors really show out. And then utilities not too far behind. So, interestingly enough, right, you think utilities, consumer staples, right, risk off. Consumer staples is down here. Utilities up here. So perhaps this is more rate sensitivity, reactions going on in the market. It did on live stream take a new trade, swing trade, and that happened to be in the utilities sector. So if you stick around, I'll show you that specific chart because I think it's still fairly early if we're going to get some relative strength there in utilities. We'll take a look at the S&P 500 on the daily time frame. We do still have a bearish divergence here that is currently forming. The market continues to just press higher through that 6,700. If we get below 6,700, like I said, that, be a little bit more cautionary below that level, but the market still remains in this overall bullish channel. From a week to date perspective, I did find it interesting if you look over here at this kind of shock move in the markets, right? The shock move being that was the pandemic. Now, we don't got the stimulus like we had the bazooka and the Fed step in over here. But what I do want to call out is the V-shaped recovery on that move, right? We saw steep sell-off over here. We saw a V recovery. And I just want to call out that there were moments in time where we did, once again, get some very, very volatile trade in and around, right, those prior highs. Okay, and then obviously 2022, this is where it comes to like trading. And when you if you want to be really good at trading and you've been doing good these last couple of years, right, 23, 24, 25, right? Say if you've been doing good these last 3 years. Also to note, 2021, people made a lot of money, but almost all those people, right, that was new to the stock market, loving the trends, got in the hype, none of them lasted through 2022, okay? And I could say this, with pristine precision because during 2021, during this time, I remember I started a TikTok and talking about various stocks like AMC at $2, right? Doing like all those stock things, and the market started going crazy. I remember getting 80,000 followers in a single day because of how frivolous everything was. And then after 2022, I don't get any views. I don't get any followers on TikTok anymore because they all got wiped out, okay? So the reason why I'm pointing this out now is because we will see volatility like this enter into the market again. And what that looks like, I don't know. I couldn't tell you. Maybe it does come back to the 40-week moving average at some point, a little bit higher, come back in, maybe shakes people out, maybe goes up higher like Paul Tudor Jones says, and then this whole thing, implodes on itself where we go through, multiple years of consolidations and trying to, digestion or whatever. Now, during this process here too, during these little areas, I was noticing that as we were pressing higher, you can see that the MACD was almost about to roll over here, and it was kind of getting there, but you can see the histogram kind of dying off too. And I just wanted to call out, you have some very, very strong momentum in the MACD, but yet the histogram itself has been kind of fading over here, letting us know that, hey, maybe perhaps this move is nearing that point where we're going to have to see it consolidate. Okay, Bitcoin saw some big moves, some big strength here, reaching to new all-time highs. Is it getting a little frothy? Probably so. Needs to digest this move here. Gold, the same exact thing. Big move. And I'm pretty sure this is the most overbought I've ever seen the RSI, as far as like when I've been trading gold, 84.57. So new all-time highs in gold. I'd have to see if it's a new all-time high on the RSI. I doubt it. But now we're not too far off that 4,000, which was kind of the level it seems like it wants to go and test out. So gold just on this parabolic run. Maybe this is all an inflation trade, right? Look at silver, almost near its 2011 high and the one prior to that. So massive moves there. It's still very correlated to miners. So, it's going to be an interesting here if silver starts to take a back seat, or if, you get some volatility in the markets. These things I just feel like these could potentially get crushed at that point. So I'm keeping a close eye on miners because those are only one of the sectors that I feel most comfortable and I have the best track record with shorting those specific plays. If we take a look at the Sailor to Shift tool, we did get a buy signal. It's already fading a little bit, but we did get a buy signal because of this week's candle over here, buy trigger, buy signal. So I look at consolidations and see if this can hold. And if so, I look to play continuation of those consolidations, whether it be in Bitcoin, Ethereum, various crypto equities, you name it. If we take a look at the 10-year yield, we did see a move up higher today. It's kind of bouncing with oil, as you can see. If I just bring up the 10-year yield, it's now trading at 4.16%, right? It got a little rejected over here, pulled back. Now it's putting in a higher low. So are we going to start to break through this? And are we going to start to see inflation concerns continue potentially in the overall markets? If we take a look at the dollar, also dollar saw a little bit of a bid today too, as this RSI divergence is playing out. If the dollar starts getting above 98.50, perhaps we do have some more room to go up. And remember, a rising dollar and a rising yield, they've had negative correlations on the markets. Now, correlations do change over time. However, just be aware that if these continue to go up, it's going to probably put pressure on things like gold, right? Gold was up pretty massively today, but yet the dollar was up. The 10-year yield was up, right? Silver was up massively today, but the dollar was up. And, markets were up today. The dollar was up. The 10-year yield was up. So continue to watch the correlations, because if we do get continuation, I think that's going to actually affect the markets until it's obviously next move. If we go ahead and look at the relative strength ratio rate of change between utilities and S&P 500, it's showing that utilities are outperforming the S&P 500 on a 4-week basis. And that is why, as we were flipping through here, I was looking at I don't really have any utility exposure. So I, on a live stream, looked at CNP, and there's a couple other ones. I can't remember the exact names, but I think Duke looked good. A couple other names look really good. I can't remember, but I did enter into CNP on the live stream, and I just like how it had this cupping pattern, this handle over here, and we broke out nicely. And then now we have a strong, a bigger base, still well within bullish context, and we're trying to break out of it there. So I entered in, I'm up very slightly. My stop is going to be down here, and I'm looking for continuation of this base breakout or potential base breakout in this specific name. If we look at CPC, total put to call ratio, but we look at the 10-day moving average, it's still not overly frothy to the downside. I would say, I get a lot more cautious when the 10-day moving average of the put to call ratio is below 0.8, because that's where we've seen the market all of a sudden go through more volatility, as you could see prior. And then even over here, it got frothy, and it went sideways for 3 months. It didn't go anywhere. It was just in a tight range before finally exploding through that. So when we get under that 0.8, it just tells me that the sentiment is much more bullish, more of an extreme. And that's when I would like to just reduce even further in my portfolio, depending on what I have at the time, and or maybe even potentially start to look for various hedges in the market that may arise. If we take a look at the Nasdaq-McClellan oscillator, there are still divergences building in this market. You can see that we're still seeing a series of lower highs here as the Nasdaq continues to press higher. Some of these already played out in small pullbacks, but now you can see the market's been pressing higher and we still have a clear divergence there. So either we're going to get a breadth, impulse where this thing could press higher and we get some of the names to actually, play out. But right now, the reading right now is under 0. So it's not the greatest reading. As far as the old fool indicator goes, the one that we divide the Nasdaq composite into the total put to call ratio, this one still green lines above the blue line, which are the moving averages to kind of smooth out the data. So the buy signal was there in May, that was over here. And the market really has just been kind of going straight up since that point in that channel. We were watching it closely to see if we can get a crossover. This is a massive lagging indicator, but yet it can catch big trends. So I like to closely pay attention to that. The last sell signal was over here, and you can see the market obviously sold off prior to this crossing over, right? It's not like a leading indicator, but then the market actually did have some more sell side, but that's not how it is, all the time in these markets. That's all I got for you on today's episode, everybody. Hope it helps out, give you some insight into what it is that I'm seeing. I'll see you on the next.